Accounting of shares and debentures. In this class, we'll try to finish off issue of shares as well as forfeiture of shares. You might have studied all these things in your plus 2 study. Okay. Anyhow, I just give the total importance over this topic, how much this will be applicable for your professional exams. Okay. Now, company SSA wants around 1 lakh rupees for running the business. This 1 lakh is collected from selling 10,000 shares, and every share has a value of rupees 10. This 10 is called face value. Is that okay? The 10 rupee share can be issued in the market for rupees 10 itself, or sometimes it may be issued at 12. This is issue price. If the shares issued at the face value, then it is called par issue. If the shares issued more than its face value, then it's premium issue. So we have two types of issues. And 10,000 shares are going to be issued, and investors should purchase for 10,000. Maybe there may be chances of subscribing all the 10,000 shares, or maybe only 9,500 shares, or only 500 shares. Okay. Sometimes the subscription may be more than 10,000. Probably 15,000 shares also be purchased by the shareholders. If the number of share applications purchased by the investor is less than the number of shares we are supposed to issue, then that will be called as undersubscription. Now, in case of undersubscription, with the amount collected, if you are able to run the business, then okay, you can allot the shares, and with that money you can start and run the business. If it is not at all possible, then you have to close the applications and refund that amount, close the business. For example, out of 10,000, we got only 500 shares subscribed by the investors. 510, almost 5,000. We are in need of 1 lakh rupees, but we collected only 5,000 rupees. It's not logically possible to run the business, so you can simply close this. Also, after subscription, you can cancel the subscription plan and refund this money. But almost closer to 1 lakh. In case of 9,500, we supposed to issue 10,000 shares, but we got around 9,500. Only 500 shortage is there. You can now make up that 5,000 rupees, 500 into 10, 5,000 rupees you could make up with arranging some long-term debt. You can run the business. Then also you can apply, means allot. So this is under subscription case, still we can allot. This is under subscription case, we can cancel and refund. And subscription matching will be very rare. The investor purchased more than the number of shares the company proposed to issue is called oversubscription. And the investors are willing to purchase more than the 10,000 number of shares, yet the company cannot issue even single share more than the company proposes to issue. The number of shares the company proposes to issue in this case being 10,000, but the shares subscribed by the investors being more than 10,000, probably 15, the company can allot only 10,000. The excess 5,000 should be anyhow cancel and refund. In case of oversubscription, this is called oversubscription. This is called undersubscription. In case of oversubscription, we can allot either only to the extent of number of shares possible to allot, balance is rejected, or we can allot in pro rata basis. Okay, reject and refund the excess, or do the pro rata. Two models are there, so you have to understand these models. And the issue price, this amount not be collected in single lot. Okay, it will also be collected in multiple installments. Probably at the time of application, you just pay me 3 rupees, on allotment another 2 rupees, first call 2 rupees and second call 2 rupees. Like you can collect the amount recoverable for the share capital in multiple installments. If we assume that we collected our required fund without any hiccup, if there is any trouble means default happens. Okay. No default is the primary situation. If any of the dues not collected, then it is called default situation. In case of default, what happens? That will be the complicated illustration. So most probably you'll expect that case only. The basic illustration where we supposed to collect the share application money in installments, we call for, and then the shareholders are paying all this money in due course without any default. That's the basic illustrations. After calling, some of the shareholders are not paying any of the dues, then it is called default situation. So you have to be double cautious with how can we handle in case of default situations. Is that clear? We'll now start with what? Each and every dues, how can it be collected? Okay, let's see. First due being this one. Second due. Okay, and these are the multiple calls. Maximum you can make 3 calls to collect the entire money. I assume that we have 1 call or 2 call or 3 call as the situations may be. Predominantly in most of the cases we have application money to be collected, and second one being the allotment and third one being the calls. Calls may be 2 calls or 3 calls. Let's see. In case of share application money collection for the first due. Can you guess how many shares are going to be purchased by the shareholders who will call for the subscription? Definitely not so. Unless the shareholders are willing to take up, we are not sure. So, in the very first instant, we call for subscribing our share, asking the investors to pay around 3 rupees. Around 3 rupees for the application. You just apply for. We'll finalize later on. If the number of applications we received is more than the number of shares we're supposed to issue or subscription, we can plan then. If it is very, very lesser than the number of shares we propose to issue over under subscription, okay, which is not possible, you can refund. So I am not confirming whether I am able to issue properly or not. So in that case, I just give an indication, give the application, you give the application money and take the application forms also. Confirm whether you are able to purchase it or not. That's the first step. I collect the money by selling the applications. So further the entry being, you are collecting the money, no, so bank account debit to share application. Now tell me, what happens thereafter? We supposed to issue 10,000 shares, application collected for 500. What we can do? Cancel and refund. No chances. If I get 10,000, very happy. Now I will confirm and intimate to you, I am going to allot the shares. As I plan to allot the shares, the application money you have paid to me, no, will be now transferred to where? A part of capital account. Share capital amount is 10. I collected 3 rupees for the application. I am not sure whether I am capable of issuing all the shares proposed to be issued or not. So I just cautiously collect the money and keep that money in the share application. The moment I confirm I am able to issue, then automatically the application money will be transferred to share capital. Is that okay? Now, on the at the time of allotment only, it is confirmed that application money is going to be adjusted to the capital amount. So that the entry being share application to share capital. Share application account debit to share capital. Clear? Immediately while allotting, I will intimate, sir, your application sanctioned, you are going to be allotted share, give the next due. The next due is all about allotment due. Now I call for, can you guess how many shares for which I am going to get the share allotment money? Once allotment is confirmed, I am able to understand how much money I can get. In the colleges, right? So the college has 50 seats for BCom students. And how many students will be admitted? We are not sure. We are capable of admitting 50. If I get the application forms only for 15 students, then what happens? I can fill only 15 students vacancy. If I get 60 applications, I can fill only 50. So I'm not sure. Is that clear? I will just call for application for joining BCom course. So if I get only 15, very happy, then I allot. What is the next semester fees? For next semester fees, I am pretty sure I will get the semester fees for 15 students only. If I get around 50 seats filled, what's the semester fees I am going to receive in the next month, next semester? For 50 students. Similarly, once allotment is confirmed, I am able to find out how many application, I mean, so for how many shares I'm going to get the allotment money. Number of shares allotted is final. So, in case of allotment, due entry will be the first one. What is that? Share allotment. Due entry is the first one. While passing the due entry, due is for what? Due is for share allotment. So, share allotment account debit. Share allotment account debit. Okay. Share allotment account debit to share capital. Clear? This is the second entry. So I intimate that you are in the time to pay the second due allotment. I call for and I collect the next one. Next one being the receipt entry. What's the next entry? Bank account debit. Bank account debit to share allotment. Is that clear? This is what? About the allotment money receipt. For the share application, first entry being the collection, next one being transferring. From the second due, first entry being the due, next entry being the collection. Because I'm not sure how many applications are going to be received. So, keep debiting the bank account and credit the share application money the moment when you receive the application money. But once you confirm the number of shares to be allotted, now you are pretty sure how much money you will be receiving for the allotment. So, due entry is first and then call for collecting that money. And the next collection entry will be there. What about the subsequent calls? Subsequent call also the same. I'm sure for how many shares I'm able to get the call money, and just based on the number of shares allotted, I collect the money. So first due entry will be passed for a call, for share call account. First entry being share call account debit to share capital. Next one being the correction entry, bank account debit to share call account. If we have 3 calls, what happens? The last 2 journal entries are repeated 3 times. The basic entry is over. Okay. Let me try to finish off all the illustrations so that you will be able to understand all the logics, even including the default scenario. Come on. Join with me. Here you have to solve the illustrations with me. This one page, that's more than enough to understand the entire issue of shares concepts along with the forfeiture. This one page. In your note also keep the first page blank. Then and then whenever I add one extra point here, you can write in the very first page itself. You can have a single page. That single page is enough for reference purpose. Right, keep it. Right now and then whenever I keep this page ready. Let's start with the first illustration. Ready? Yes. Now, join with me to solve this. So, this chapter is very interesting chapters. Majority cases is only repetitions. I could still remember one of the toughest illustrations in this chapter. Okay. I asked as an open challenge to solve for a student studying +2, because we had the classes in Chennai for +1 +2 students itself, focusing for the CA exams. One of the students now doing his CA final, I asked him visit to Trichy also now and then to address our students. Okay, so but he could not turn up as he is going for this examination this time. May come the later period. Okay, I'll introduce him. I asked him to solve this question, and he took almost 2.5 hours to 3 hours to solve this illustration in his own form. Take the challenge. Before you come for the next class, you try to finish up that illustration yourself, right? Would you like to take the challenge? This question. Do you have this question for CA Foundation? Advanced question number 1. Do you have this or not? Those who wants to take the challenge, you can try that question number 1 yourself. Before you come for the next class. Okay. CA Foundation. CMA Inter you have, I know. What about CMA Foundation? After the 19th sum, I think. You have this or not? You have. So you can solve this illustration yourself. Don't see the answer. Anyway, let's start with the question number one. From first question to at most 7 or 8 questions. No, it's very easy question. Very easy questions. No need to waste for my own lecture. You can start joining with me to work yourself. Come on, make it faster. The company X issued 10,000 shares. Planned to issue 10,000 shares. Having face value 10, issue price also 10. All the shares were subscribed and allotments was made. So this is what about the number of shares issued, number of shares subscribed also be 10,000. The share price was receivable as follows: 3 on application, 4 on allotment and 3 on call. You are required to pass journal entry, prepare ledger and balance sheet. Okay. So you have to pass journal entries first and prepare ledger and balance sheet also. So 2 journal entry for application, 2 journal entry for allotment, 2 journal entry for the call. For the first one, due collection entry will be posted, then transfer entry. Subsequently, collection and due entry first and receipt entry next. Come on. On application, how much money you collected? 3 rupees per share. How many shares subscribed by the shareholders? 10,000. So 10,000 into 3, 30,000 rupees you collected. So bank account debit to share application. To share application. The value being 30,000. Right. Then the amount collected for application is nothing but a part of capital only. So I am transferring the application money to the capital account. So share application account debit to capital account, share capital account, 30,000. Next being for allotment. On allotment, first entry being due entry. So you have, you have to collect the amount for share call, share allotment, account debit to share capital. 4 rupees per share for number of shares allotted here being 40,000. Sorry, 10,000. 10,000 into 4, 40,000 rupees will be the value. No due, we collected comfortably. So the entry for collection being bank account debit to share allotment. To share allotment. This value being 40,000 rupees. Then you can move on to the next one. On call, we have only one call. So the due entry for call being share first and final call account debit, due entry to share capital. This value being 3 into 10,000, 30,000. No default, so we collect comfortably. The entry for that being bank account debit to share first and final call account. Value being 30,000. Value being 30,000. Okay. Now we have to prepare the ledger. Post these things into the ledger as well as we have to prepare the balance sheet also. Okay. So I'm not going to prepare the ledger always. Only for this illustration I'm going to prepare the ledger because ledger preparation is very preliminary level. You can manage it easily. And while preparing balance sheet may be pretty different because you have to follow the company's balance sheet format. Okay, as per the format given in Companies Act. Okay. Now let's start with bank. Bank to share application. 30,000, and to share allotment 40,000, and to share first and final call, simply call 30,000 rupees. That's all. By balance carry down, balance carry down, total being 1 lakh. Is that okay? Then share application money. For share application, bank and capital, leaving these to all other ledger accounts may be closed. By bank 30,000, and to share capital 30,000, it is closed. And share capital by share application, the value being 30,000. Okay, 30,000, and share allotment 40,000, and share first and final call, simply call 30,000, and you get the balance carried on here 1 lakh. 1 lakh. Is that okay? Then share allotment account, here to share capital, value being 40, and by bank, value being 40. This ledger is also closed. Share call account to share capital 30,000, here by bank 30,000. This one also closed. Now, in case of company's final accounts, balance sheet. Okay, part 1 of Schedule 3 of Companies Act gives this format. Schedule 3, part 1 gives the format. As per that format, you have to start with equity and liability, first block, and second block is all about assets, 2 blocks. Balance sheet, assets and liabilities, you know. Here you write the equity and liabilities, the top second half will be the assets. In equity and liability, first one being the shareholders' funds. Under that, equity share capital or simply share capital, and reserves and surplus. Okay, and then non-current liabilities, third being current liabilities. Similarly, in asset, we have non-current assets, second being current assets. That's the format. But while writing the share capital account, you have to include authorized capital and called up capital, subscribed capital, authorized, issued capital, subscribed capital, called up capital, paid up capital. You need to give all these details. Most of the times in your one word question, you may be asked to answer these kinds of different capitals. So I will explain those things at the last. As per Companies Act 2013, authorized capital, issued capital, unissued capital, called up, uncalled, subscribed, and paid up and unpaid. You have to understand all these variants of the capital term used here, along with the reserve capital. I will explain these theoretical aspects the last, but which is very, very important for your examination. Don't miss. Okay. Clear? Hope you will be now able to understand the preparation of the complete one. Hereafter, hereafter, here we have the bank account, a part of current assets, value being 1 lakh. Share capital we have 1 lakh. All other ledger accounts are closed. The balance sheet total being 1 lakh. Hereafter, I never bother about opening these ledgers and balance sheet. Finally, you will see the balance sheet format only. That's enough, more than enough. You are not asked to prepare the ledgers most of the cases, right? So always you have to be master with the journal entries or uh, practical system, subsidiary books. So you need to know how to pass the subsidiary books and journal proper also. Sometimes those types of questions may also be asked. In this illustration, I have given all the journal entries as well as ledger and balance sheet, of course not required. In case of balance sheet, shareholders funds and non-current liabilities, current liabilities. Three aspects are there. In assets, we have two aspects, non-current assets and current assets. Of course, ledger you may know already, so you no need to worry about the ledger preparations, only the balance sheet format. That too, I have given a condensed format for your better understanding. Here we have used the different terms like authorized, issued, subscribed, called, and paid up. I will explain all these things the last. No need to worry about that. Is that clear? Now, online students, come on. If it is clear, text me. So we'll move on to the next illustration. Next illustration, you have to join with me to solve this. Yes, come on, solve this illustration. The company X issued 10,000 shares having face value rupees 10 for 10. All the shares were subscribed when allotments was made. The share price was receivable as follows: 3 on application, 3 on allotment, 2 on first call, and 2 on second call. So here I've included 2 calls. We need to pass only journal entries. The ledger, very rare. But balance sheet, of course, you have to understand. And subscription also be the same. Yes, come on, pass the entries. You have to pass 2 entries for what? Application, 2 entries for allotment, 2 entries for the call, and another 2 entries for second call. Okay, make it faster, make it faster. On allotment, sorry, on application. First, you have to pass the entry for the receipt of application money, bank account debit to share application. Number of shares subscribed by shareholders being 10,000. For every share, application money being 3, so 30,000. Join with me to solve this easily and fast. Make it fast. And then this share application money is part of capital, so I am transferring the application money to the capital. 30,000 rupees. So first one is over. Second one being allotment. On allotment, first entry being the due here. Share allotment account debit to share capital. Amount recoverable for the allotment being 3, so 3 into 10, 30. Due entry passed. Next we call the due and we collected the due without any fail. Bank account debit to share allotment, the value being 30, 30. Now we'll move on to the call. As we have 2 calls, you can name the call. Call number 1, call number 2. On first call, you have to pass a due entry first. Share first call account debit to share capital. To share capital. This value being 2 into 10, 20,000. And then you collect that. There is no any default here. So bank account debit to share first call. This value being 20. And you can go for on second call. Share second call account debit to share capital, the value being 20 again. Now I am collecting this money, so bank account debit to share second call, 20,000 rupees in thousands. Clear? Move on to the next illustration. Move on to the next illustration. Now, in this illustration, the company XC issued 10,000 shares having nominal value of rupees 10 but for 12 including premium. So issue at a premium. If nothing stated, that additional money over the face value collect named as securities premium usually collected with this share allotment money. If nothing stated. Okay, all the shares were subscribed and allotments were also made. We thought to issue 10,000 and we got 10,000 shares subscribed without any deviations. The share price is receivable as follows: 4 on application, 5 on allotment, including premium 2. This 5 includes 2 rupees premium and balance 3 will be on first call. So now I am going to introduce one more aspect here. What happens if the shares are issued at premium 10 plus 2? This is called premium issue. We have already completed what? Normal issue at par and issue at equal subscription also completed. In case premium issue, what we'll do? So in case of premium, the amount recoverable for allotment money will be in addition to the face value, which is called securities premium. So the entry is slightly adjusted here. Securities premium is my revenue, so I posted that in the credit side. Share allotment account debit to share capital to securities premium. One more account is now introduced in the credit side. Share allotment to share capital to securities premium. Is that clear? Clear? Only one adjustment, rest will be the same. Always remember, share capital will be appearing at its own original par value. Any amount you collect excess will be named separately, named as securities premium. That securities premium, if you are getting more than its expected value in, you are happy. So it's a revenue. Revenue should be always credited. So it should be posted in the credit side. One extra adjustment. Yeah, come on. Finish up this particular illustration. Make it faster. Now, on application, I collect 4 rupees for 10,000 shares. Bank account debit to share application. 10 into 4, 40,000 rupees. And the amount received for the application is part of capital only, so I transfer that directly to capital account. So share application account debit to share capital, this value being 40. And next one being on allotment. The amount recoverable for allotment being 5 rupees. So share allotment account debit, 5 rupees per share. For 10,000 share, I need to get 50,000 rupees. Though the amount recoverable for the allotment is 50, in that 50, for capital is only 3. So additional 2 rupees you collect in excess than the face value will be securities premium, will be credited in securities premium account. This value being 20,000. Share allotment. The next one being collection. So bank account debit to share allotment. Bank account debit to share allotment. No default, we collected this 50 rupees completely. No problem here. Application allotment is over. Now let's move on to the next one. On first call. On first call. Okay. On first call, first entry being the due entry. Share first call account debit. share first call account debit to share capital. First call being, it's first and final call, only one call, right? First and final call account debit to share capital. The amount recoverable being 3 rupees per share for 10,000 shares, 30,000 rupees. 30,000 rupees. Due entry is passed. Next one being the collection entry. So bank account debit to share first and final call account. The value being 30,000. Clear? Now let's move on to the next one. Complete along with me. Don't delay. Don't delay cases. The rest of the things are very simple. Under subscription, number of shares planned to be issued is 10,000. Face value 10, issue price also 10. 9,000 of which we had subscribed, but subscription happened only for 9,000. And allotments were made, though it may be under subscription, but possible to run with this under subscription, the company allotted the shares. The share price was receivable as follows: 3 on allotment, 3 on application, 4 on allotment, and another 3 on first call. See, very first page I gave the format, right? So in this format, now we are going to discuss what? This aspect. So I just put the tick mark for each and every aspect so that everything will be covered. So application money, allotment money, if we have multiple calls, how can we handle? We have seen. In case of par, in case of premium, we have studied all these things. In case of under subscription and equal subscription completed. In case of over subscription, we'll see that later. Without default model is the first basic ideas. And after the case, we move on to the default of any of the dues, right? So in case of under subscription, only one thing you have to do. What's that? Okay, the excess application money. Sir, you collected money only for the number of shares subscribed for. So you have to calculate for all these value based on the number of shares subscribed. Okay, come on. Now, an application. You collect the money first, bank account debit to share application. This issue will have no meaning at all. Only we can get the money for the number of shares subscribed for. 9,000 into 3, 27,000. The collected amount is transferred to capital account. So share application account debit to capital account. Share capital account. 27,000. Next being for this one on allotment. Share allotment account debit to share capital. You collect the allotment money of rupees 4 per share for number of shares subscribed for 9,000. 9,000 into 4, 36. And no default happens, so we collect the entire 36,000 rupees here. So bank account debit to share allotment. The value being 36,000. And on call, 3 rupees is the due. So share call account debit to share capital. The amount recoverable for the call being 3 into 9,000, 27,000. No default happens, so we collect comfortably. Bank account debit to share call, the value being 27,000. 27,000. Is that clear? Online students, come and respond me. Make it faster. Are you comfortable with the illustration we solved up to now? Come on. If it is clear, text me. We will move on to the next illustration. We'll go for the fifth one. In the fifth one, we will be dealing with oversubscription and rejections of excess applications. Now, in the very first page, I'm going to incorporate this one. C, company collected application received being 10,000, 15,000, 20,000, 20,000. Total 45,000. Is that okay? But the company can allot only 30,000. The company can allot only 30,000. This is oversubscription. The company planned to issue 30,000 shares only, but the investors are willing to purchase 45,000 shares. Oversubscription. Now, how can we allot? A demanded I want 10,000 shares. B demanded I want 15,000 shares. C also demanded 20,000 shares. So, the demand of these three shareholders is almost 45,000 shares, but we are not able to issue more than 30,000. So, how can I allot? I can allot this way. A will get fully, C will get fully, B will get nothing. So, what happens in this case? B has applied for the shares, we have collected application money. We have to now send him a regret letter. Sorry, sir, your application is not honored, so we have to refund this money, take it back. So, when the applications are completely rejected, that application money received will be refunded. This is one type. Complete rejection type. What about the pro rata, sir? Subscription being 10,000, 15,000, 20,000, overall 45,000. Now I plan to allot. I can allot only 30,000 shares. While allotting, I offered 8,000 shares to him, 12,000 shares to him, 10,000 shares to him. So here, A applied for 10, but he got only 8,000, balance 2,000 rejected and refunded. Similarly, in case of B, applied for 15, but we allotted only 12,000 shares, balance 3,000, application monies are refunded. And C allotted only 10,000 out of 20,000 applications. Now see, in the first scenario, the application money what you receive, is refunded. In that case, share application to refunded scenario. Is that clear? This one will be refunded. B's amount is refunded. A's application money, C's application money in the very first case can be transferable to the capital account. B's application money we have received, no, so we have to refund this. But in case of the next one, proportionately allotted. All the shares not allotted, all the shares not rejected. If you apply for 4 shares, you may be allotted 3 shares or 2 shares. I don't say nothing is allotted. I will allot a few shares. Few shares are rejected. In case of A, 10,000 subscription done by him. So for the 10,000, he has given me application money, but allotted only 8,000 means there is 2,000 shares are going to be rejected. Application money on that is refunded, Instead of refunding that rejected application money, this fellow got 8,000 shares allotted. No, he has to pay allotment due in the next call. I tell him, rather than refunding, can I adjust that excess application money in the next due? Yeah, of course you can adjust. That is called pro rata basis. In case of pro rata basis, the 2,000 application money, instead of refunding, is adjusted. Here it is refundable. Here it's not refundable. Adjustable in the next due. So where it is going to be adjusted? To share allotment. The allotment money what you supposed to receive will be now adjusted. This one balance is receivable. You just think over, I need to get around 10,000 rupees allotment money. Already I have 2,000 rupees received in excess with the application money to be adjusted here. So after subtracting this to 8 may be recoverable. Two possibilities are there. One is completely rejected. In that case, complete application money is refunded. Next one is proportionately rejected. To the extent of proportionately rejected excess application money, can be used for the next dues adjustment. I don't refund. I name this being the share allotment. Is that clear? This is the logic. Let's try to solve this one now, so that we'll be able to understand this easily. Oversubscription and rejections completely. The company X issued 10,000 shares. This is issue. Nominal value 10, issue price 10. Number of application forms subscribed being 12,000. Okay, and 10,000 of which were allotted. So out of 12,000, 10,000 were allotted. The excess application money were rejected. So here 2,000 excess rejected and that application money is refunded. And balance were allotted fully. This is allotted fully. The share price is receivable as follows: 3 on application, 4 on allotment, and another 3 on call. Let's start with one after one. So first we'll start with this one. On application, bank account debit to share capital. How much we collect now? We collect for 12,000 applications at the rate of rupees 3 each. So 36,000 rupees we collect. Now, bank account debit to share application. Share application. This share application money is transferred to share capital. So share application account debit to share capital. But in this case, this one is going to be refundable. The application money we have is 36,000. Allotment is made for only 10,000 shares. 10,000 into 3 rupees only can be transferable from application to capital. The difference between these two will be refundable to bank. It is going to be refundable bank. Is that okay? Now on allotment. Hereafter only 10,000 allotted. No, you will collect the money only for allotted shares. 10,000 into 4 due entry. Share allotment account debit to share capital. 10,000 into 4, 40,000 rupees. And there is no any default here. We collect comfortably. So bank account debit to share allotment. Only 40,000 rupees. And then we'll go for on call, the last due. Last due 3 rupees also collected only to the number of shares allotted for 40,000 in 10,000 into 3, 30,000. So share call account debit to share capital. 10,000 into 3, 30,000. Then next one being the collection. Bank account debit to share call. Value being 30,000. Value being 30,000. Clear? Now, let's move on to the next illustration. In the next illustration, it is all about pro rata. All the shares not allotted, all the shares not rejected. Or proportionately allotted is called pro rata allotment. Company issued 10,000 shares and nominal value being 10, issue price also 10. An application received for 12,000 shares. An allotment was made in pro rata basis. What does it mean? 10,000 shares for every 12,000 applications, or 5 shares allotted for every 6 shares. That's what about the ratio. If you apply for 6 shares, you'll be getting 5 shares. That's the logic. So as it is being the pro rata allotment, the excess money not refunded can be adjusted in the next due. Is that okay? Very, very important. And then this money 10 receivable in 3 installments, 3, 4, 3. What is the journal entry for the application? 3 into 12,000. You collected the application for the 12,000 shares, so 12,000 into 3 being the application money. So on application, bank account debit to share application. This value being 3 into 12, 36,000. Then what happens to the share application? The share application money, what you have here, transferable to the share capital account to the extent allotted. What extent allotted? Only 10,000, right? So 10,000 into 3, 30,000 is transferable to the share capital. So there is an excess application money of 6,000. What we can do, sir? Very simple. That can be adjustable in the next due. What is the next due? Share allotment is the earlier case rejection. So we don't have any dues recoverable from them. So you have refunded. But here, the amount recoverable from the allotted persons being the next due, allotment due. So in that we'll adjust. Now what is the due for allotment? On allotment, share allotment account debit to share allotment account debit to share capital. What is the due for share allotment? 4 rupees per share for the number of shares allotted being 10. 10 into 4, 40,000. But how much I will receive the money? Come on, tell me. Bank account debit to share allotment. Come on, tell me, make it faster. To share allotment. How much I will collect? Yeah, 34,000. 40 minus 6. I have to recover 40,000 rupees already. There is excess money refundable being 6. I will subtract and balance 34 only I have to recover. This adjustment is very, very important. Allotment over. Then we'll go for the final call. On call. The due entry for call being share call account debit to share capital. It's very simple. 3 rupees into 10,000, 30,000 rupees, no default, we collected comfortably. Bank account debit to share call. This value being 30,000. This value being 30,000. Is that clear? So we'll now move on to the next one. So in this case, we have rejections as well as pro rata both. Rejection and pro rata both. So it's a combination of these two models. We have seen rejections only, pro rata only. Now we see a portion is completely rejected, another portion is allotted pro rata basis. So we have completed all these things. In the upper side is completed fully. Is that okay? So in share application, while transferring application money to capital, if there is any excess application money rejected, that will be transferable to, means it should be refundable, the entry being share application to bank. If the allotment is made pro rata, then excess application money is transferable to the share allotment. So we have completed all these illustrations. Here now we'll have combination of these two. The company issued 10,000 shares having nominal value rupees 10 for rupees 12, including premium 2. 15,000 applications were subscribed, subscription being 15,000, out of which 3,000 were rejected. 3,000 rejected and refunded, and money on it was refunded, and the balance were allotted in pro rata basis. Balance 12,000, you know, balance 12,000 applications you have still. This is allotted for the 10,000. These 12,000 applications were allotted only 10,000 shares. This is pro rata. So we have both. We have both. The share price was receivable as follows: 3 on application, 6 on allotment including premium rupees 2. It means 4 plus 2, and call being 3 rupees. Call being 3 rupees. Come on, tell me. On application, bank account debit to share application. How much you will receive? 3 rupees per share. Number of shares subscribed for is 45, 15,000. 15,000 into 3, 45,000 you may receive. 45,000 you may receive. Okay. Now, next one being, how do you handle this? Share application account debit to what? Share capital. How many shares are going to be allotted? Only 10,000. So 10,000 into 3, 30,000 is transferable to the share capital account. For this 3,000, you know, the application money is always be refunded. The entry being share application to bank. I pass the combined entry here, 9,000, 3,000 into 3. And here there is excess application money for 2,000 can be adjustable in the next due allotment. So I name this being to share allotment. 2,000 into 2, 4,000, 6, 2,000 into 3, 6,000. Then on allotment, share allotment, amount recoverable for allotment being 6 rupees per share into number of shares allotted, 10,000 into 6, 60,000. Out of that, only 4 rupees is for what? Share capital. 4 into 10,000, 40,000. Another 2 rupees is for securities premium. 2 rupees into 10, 20,000 rupees. Clear? Now, while receiving the money, what is the entry? Bank account debit to share allotment. How much you will receive? Come on, tell me. Out of 60, there is an excess application money to be adjusted in allotment being 6,000. The balance net value 60 minus 6, 54,000 is recoverable. 54,000 is recoverable. Clear? Then on call, no problem hereafter. In case of call, 3 rupees for 10,000 shares. Share call account debit to share capital. 3 rupees per share into 10,000, 30,000. Is there any default here? No default, completely received. So the entry being bank account debit to share call account. Clear? So with that, we have completed the first block. Up to now, we just did warm up only. Hereafter only we need to study illustrations for our professional exams. Forfeiture onwards will be for professional exams. Now, as per Companies Act, authorized capital or nominal capital, what does it mean? The maximum capital the company is authorized to issue being authorized capital by the memorandum of the company. Okay, company has memorandum of association and articles of associations. In memorandum of association, capital clause, name clause, objective clause and place clause you might have studied, where in capital clause the company maximum number of shares issuable will be given. The company cannot issue even single share beyond this. If they want to issue further, then they have to get the approval from the meeting. Okay, they have to contact the meeting and get the approval. If the company has an authorized capital of 1 lakh shares or rupees 10 each, 10 lakhs. But currently they are not in the need of all the shares to be issued. Probably the company can issue only a portion of this. Assumed only 50,000 shares are currently issued at the rate of rupees 10. 5 lakhs. This is called issued capital. The company proposes to issue to raise the fund currently is called issued capital. And what about the subscribed capital? Out of the issued capital, how many shares investors are willing to take up is the subscribed capital. Suppose only 48,000 shares are subscribed at the rate of rupees 10. This is subscribed capital. If the number of shares subscribed by the investor is more than 70,000, then what is the subscribed capital? By the time also 50. Because in case of oversubscription, excess money will be rejected and refunded. So only in majority cases, issued capital and subscribed capital are same. Is that clear? Clear? Hope you'll be now able to understand. So authorized capital is the maximum permissible shares issued by the company as per the memorandum of association. Out of that, how many shares the company proposes to use currently for raising the fund for business operations is called issued capital. Out of that, how many shares investors are purchased or investors are willing to purchase is called subscribed capital. And the difference between these two, okay, the difference between these two, 50,000 will be called unissued capital. Unissued capital. Unissued capital, subscribed capital. Now, what is called up capital? The share price being 10, no face value, maybe 3,322. Okay. They collect the money in installments. 3 rupees for application, 3 rupees for allotment, another 2 is for the first call, another 2 is for the second call. That's how they can collect in installment. Currently, they have called for paying only this much. This remains pending to be called. Okay. So this is called up capital. This is uncalled capital. This is called uncalled capital. Clear? The company called for paying around 8 rupees per share. application, allotment and first call. But out of the 8 rupees called up, investor paid only 3 and 3. This one and this one remains pending to be payable. Then these 3 plus 3 will be called as paid up capital. Paid up capital. Is that clear? Another 2 rupees supposed to be payable later, this is called unpaid. Unpaid up capital. So, whenever the shares face value being 10, out of 10, only 7 rupees called for to pay is called partly called up shares. Entire 10 rupees called, then it is called fully paid up, fully called up shares. Out of the total called up money, only partially is paid, then partly paid up shares. Fully paid up, then it's called fully paid up shares. Hope you'll be now able to understand. This is partly paid up. So, called up and uncalled up. Called up capital is nothing but part of capital which has been called for payment. Leaving that balance would be uncalled capital. Paid up capital is nothing but out of the called up money. The company called up to pay 8 rupees. Out of that, only 6 rupees is paid. That will be called the paid up capital and balance is unpaid capital. The last term is very interesting, reserve capital. Have you heard about the term reserve capital? You might have heard the capital reserve, but it is not reserve capital. It's not capital reserve, it's a reserve capital. Reserve capital is different, capital reserve is different. Capital reserve is a profit. Okay, reserve capital is nothing but capital remains uncalled up until the company goes for the liquidation. Until the company goes for the liquidation. This uncalled portion, 2 rupees, will not be called up until the company is liquidated. It's not going to be called up. It remains uncalled up only. The company planned not to call until it is liquidated. Then this 2 rupees uncalled up until the liquidation, is called reserve capital. Capital kept as a reserve. You know that companies are limited liability companies. Their liability is limited only. Limited to what extent? Limited to face value of the shares. Shareholders' liability is limited to the extent of face value of the share. If the share's face value is 10, okay, this is face value. Paid up value also 10. Called up and paid up value also 10. What is the liability of the shareholders? What is the liability of the shareholders? 0. Because shareholders' liability is to pay up to the face value only. We have paid completely. There is no further liability. If the face value is 10 and called up and paid up being only 8 rupees. Only 8 rupees. What is this? Whenever the company calls for paying, then each and every shareholder will pay how much? 2 rupees. They keep the capital reserve only for the emergency purpose. They will demand the money collected from the share owners. Okay, shareholders. Clear? That is why it is called reserve capital. Unpaid capital called up only on winding up. Until it is wound up, it is not going to be called up at all. It remains pending. And the business administrator may know when there is an emergency, the company can call for this remaining money for the fund arrangements. Usually, this is a rare scenario. Keeping the reserve capital is a rare scenario. Anyhow, there is a term you have to understand what is called reserve capital. Capital reserve is different. Reserve capital is different. Hope you will be now able to understand the predominant difference between called up capital and paid up capital. So, called up capital and paid up capital is very, very important term you have to understand. So, very often use the term called up and paid up. You should not get confused with these values. Are not same. What is called up value? For the face value, how much money is called for payment by the company is called up. Out of that called up, how much is paid by the shareholders is called paid up. Right. Any doubts here? Now, let's move on to the next one. Here, what happens are in case of default? Default scenarios are going to be discussed. Any default happens, out of the 3 or 4 dues recoverable for the capital, some of the dues may be pending to be collected. Some of the dues may be pending. The company can leave it to be collected later on without any hesitation. Chances are there. Or immediately the shares are going to be forfeited. Okay, forfeiture. What is called forfeiture? The shareholder for the face value of 10 paid only 7 rupees. Balance 3 rupees payable. No, the company called for paying this money. This shareholders failed to pay even after multiple calls or multiple remainders. Immediately the share allotted on that shareholder is cancelled. Immediately cancelled. Sir, what happens to the extent of money paid by the shareholders? Is also not going to be refunded, is withheld by the company in the name of share forfeiture. Is that okay? In forfeiture, we need to create a new account called share forfeiture account. What is that share forfeiture? The amount paid up, will not going to be refundable, will be now transferred to share forfeiture account. For example, out of 10 rupees, okay, 4 rupees, 3 rupees, 3 rupees. The company called for these 3 money, but this fellow paid only these 2, failed to pay this. Even after the multiple remainder, he has not paid this money. Then immediately share allotted in his name becomes useless. It is going to be cancelled. As the shares allotted being cancelled, you are no more being the shareholders. Okay, the shares allotted for me is cancelled, right? So what happens to this money, sir? This money is not going to be refundable. This will be the income for the company. That income is a temporary income named as what? Share forfeiture. Share forfeiture. The paid up value will become what? Share forfeiture. Usually the paid up value should not include securities premium collected. Securities premium collected. Very, very important point. Forfeiture happens at what point in time, sir? Fully called up state or partly called up state. So I have to incorporate all these variants in the subsequent lectures. This second block is very, very important. So each and every term I use here, keenly observe and try to use this, okay, in your solution. So forfeiture can be possible at fully called up state or partly called up state. What is called fully called up state? Now 3 rupees, 3 rupees, 2 rupees, 2 rupees. Company called for these 3 dues. Still the final due not called. This fellow paid these 2. This due could not be payable by him. Immediately his shares are forfeited. Now tell me, is it fully called up or partly called up? Partly called up. Called up only 8 rupees. Still it is remaining pending. So it's partly called up. At the partly called up state itself, there may be default. Even in that partly called up state, immediately the shares may be forfeited. This is called forfeiture of partly called up shares. I called up fully, sir, but he has not paid one due, so I forfeited. Then it is called fully called up shares forfeiture. So we have 2 states, fully called up state and partly called up state before the forfeiture. Now you'll be able to understand what is called forfeiture. The share allotted to you is taken by the company back is called forfeiture. Okay, while allotted share is taken by the company back, even though they have taken the shares back, but the amount paid by you will not be refundable. That is kept in a new account called share forfeiture. After the forfeiture, the share may be reissued. The share may be reissued. The reissue may be possible at premium or at par or at loss. While reissuing the share, it's a second-hand share. Like I issued the share to Mr. A, who defaulted. Immediately I forfeited the share from A. Now this share forfeited from A can be issued to some third party. Probably B wants to take this. Sir, I will take up Will you give me some discount? Yes, you can take 10 rupees share. You take it at 9 rupees or 8 rupees. I can reissue the same share to some third party at a loss also. Can we issue the shares at loss, sir? Yes, of course, especially when it is being the reissue of forfeited share, you can issue at loss, provided that loss should not be more than the profit attained by forfeiture of the shares. What is the profit we gained for forfeiture of share? 4 plus 3. 7 rupees we collected, you know. This 7 rupees is kept in a new account called share forfeiture. After that, that forfeited share is going to be reissued to somebody else at a loss, you know. That maximum loss should not be more than 7 rupees. It means the loss on reissue should be first adjusted in the share forfeiture. So while forfeiture, whatever the amount we collected will be retained by the company named as share forfeiture account. On reissue of the same share, if there is any loss, that loss is adjusted in the share forfeiture. So we have 7 rupees on reissue. We offer 2 rupees discount, which is loss I adjusted. Number 1, loss on reissue is adjusted in the share forfeiture. After adjusting this 2 rupees loss, still I have 5 rupees in share forfeiture. What is the purpose of share forfeiture gain? The share forfeiture gain is nothing but the amount withheld by the company is share forfeiture, which is the gain only, can be used for adjusting the reissue loss. After adjusting the reissue loss, if still we have the share forfeiture gain, what can we do? That gain can be transferable to the capital reserve if any. Second step, balance if any. Balance if any. Clear? Sir, what happens, sir, if I issue at premium? Whenever you issue at premium more than the value, always securities premium. In case of loss on reissue, that loss can be adjusted in the forfeiture account, because that forfeiture account is meant for adjusting this loss only. After adjusting this loss, still if you find any gain in the forfeiture, is no more required transferable to the capital reserve account. Capital reserve account. Now this premium being premium only. Now while reissuing, again we have 2 aspects. What are they? While reissuing, it may be fully paid up reissue or partly paid up reissue. So you have the 2 options here. So you have to incorporate all these points to master the second block. Second block seems to be overloaded by giving all the things in single shot. Let me break each and every aspect one by one so that all the concepts will be thorough. All the concepts will be thorough. Is that clear? Come on, make a note of it. I will pass journal entry for the forfeiture case also. Okay. Finish of copying this. I will go for the forfeiture. Now, on forfeiture. Always remember, on forfeiture, share capital is going to be reversed. Share capital is going to be reversed. Until earlier case, share capital is credited. Here, cancellation of share capital, automatically the share capital account is going to be debited. 2. Whatever the amount we collected will be transferable to where? Share forfeiture amount. Share forfeiture amount is the amount collected from the defaulter. Whatever the amount not collected will be shown in that concerned account itself. Share, allotment or call. Let me explain here. Share capital account will be debited with what value? What value? What value we have to show in share capital account while debiting? What value? CU, called up value. I have noted that here. While forfeiting, the share may be forfeited at fully called up state or partly called up state. If the shares forfeited after fully called up state, full value will be shown. Partly called up means to the extent of called up value will be debited. In case of share forfeiture, paid up value minus securities premium received, if any. Whatever the value we recovered while forfeiting that share from the defaulter, any securities premium received should be removed. Balance amount will be the share forfeiture amount. And share allotment and call due not collected, default. Any default due is there, no, that will be credited here. Okay, any default. Why? See, call money being 100, out of that we collected only 90. The difference between 10 rupees remains pending untallied, that 10 is going to be reversed here. So what is the journal entry for due for call money? Share call and to share capital, we assume it is 100. The amount collected is only 90. Bank account debit to share call 90. Then share call debit side 100, credit side 90. Remains 10 rupees in debit side untallied. That is going to be reversed here. So if any due is there, you know that due will be credited here to share allotment or call. The last point to be noted here is, in this case, if securities premium not collected, that should also be reversed. Rare scenario. The most advanced complicated illustration, you know that securities premium remains uncollected, like they will give, then it will be debited. It's a rarest scenario. Securities premium account is also be debited. What about this one? Securities premium not collected or default. This is the comprehensive entry for the forfeiture. Once forfeiture is over, thereafter they will go for reissue. While reissuing, come on reissue. What is the journal entry? Again, you are getting the collection for shares, bank account debit to share capital. Is that okay? Come on, tell me. At what value you will record share capital here? At what value? What value? Come on, text me, online students. At what value we have to credit share capital account? In case of bank, it's collected amount, no problem. No. Come on. At what value share capital? Yeah. So, paid up value. For example, 10 rupee shares, 3322. I called for these three, but this fellow paid only these two, not paid. Immediately I forfeited. This share, as it is failed to pay, I forfeited. While reissuing, I reissue at rupees 7, stating that it will be paid up to first call. What does it mean? The 7 rupees you paid for purchasing the reissued share, you know, will be considered worth the 8 rupees. Whenever I call for the second, you have to pay me 2 rupees. 3 rupees, 3 rupees, 2 rupees, 2 rupees. I called all the amount. You paid 3 amount, not paid this one. Immediately I forfeited your shares and reissued for 8 rupees, stating fully paid up. Fully paid up means if you are purchasing this company shares by paying 8 rupees, you are not requested to pay further anything. But while reissuing, I collected only 7 rupees, stating, sir, the 7 rupees you paid, you know, will be considered paid worth only 8 rupees. The 7 rupees is for 8 rupees means whenever I call the second call, you have to pay the 2 rupees back. Is that okay? So I can reissue the shares as fully paid up or partly paid up. If you are purchasing the second hand shares, to make you understand, there is no second hand share concept here, to make you understand. To purchase a second hand share, you have to be double cautious. The company will say it's fully paid up or partly paid up. If it is fully paid up, you are not requested to pay further. If it is partly paid up, you may at any time call for a later payment due, you have to pay. Okay. So that's the logic. That's why what is the paid up value you have to consider, that will be credited here. Very, very important. For forfeiture called up, for reissue it's paid up. And while reissuing, you'll gain also sometimes. If you gain, that gain will be securities premium. If you are reissuing at loss, the loss will be named as what? In case of reissue of loss, in case of gain, securities premium. In case loss and reissue, share forfeiture. Already told you, know, if there is any loss, that loss is adjusted in the share forfeiture. So this will be called as loss on reissue. This is gain on reissue. Clear? Once reissue is over, it's a twin brother, like automatically one more entry will come. What's that entry? In case of loss on reissue, that loss is adjusted in the share forfeiture. Don't forget to transfer any balance in forfeiture will be in CR account. No more required will be transferred to the CR account. Is that okay? The entry being share forfeiture account debit to CR account. Clear? These two are the inseparable brothers. Like any share forfeiture amount you have, ultimately after adjusting the loss, is transferable to the capital reserve account. It means I'll put this value here. Forfeiture gain minus reissue loss into number of shares reissued. This will be the amount transferred to the capital reserve. While forfeiting, what is the gain per share? While reissuing, what is the loss per share? The difference between these two is the unused gain we have can be transferred to the capital reserve. Only this 3 entry will be the complicated one for the most of the students. I have broken down all. Each and every combination I will solve with some illustrations so that you will be master over that. Clear? If it is clear, text me. We will now solve the illustrations. Now, come on, join with me to solve this illustration. The company X issued 10,000 shares having nominal value rupees 10 for 12, including premium 2. 15,000 applications were subscribed, out of which 2,000 applications were rejected, and application money will be refunded, and the balance applications were allotted in pro rata, balance being pro rata basis, and the share price is receivable as follows: 3 on application, 5 on allotment, means 3 plus 2, and 2 on first call, another 2 on second call. All the dues were collected except the shareholders who applied for 260 shares failed to pay the second call. So applied for 260 shares, failed to pay second call, default being second call, and his shares were forfeited and reissued for rupees 9. You are required to pass journal entry, prepare ledger and balance sheet. Any of ledger and balance sheets are skipped here. Also, you have to be careful. Solve this illustration using practical accounting system. What is called practical accounting systems? You have to prepare subsidiary books, cash book. Those transactions will not be recordable in any of the subsidiary books, will be recorded as a journal entry, will be called as journal proper. So cash book, journal proper, and then balance sheet. Because this question was asked once in CMA Inter, asking for solving this illustration under practical system by opening the cash book and the journal proper. This most of the students pass the journal entry only, totally disqualified. So you have to double cautious whether you have to pass the journal entry or subsidiary books. Anyhow, I am going to solve this illustration under what model? Normal journal entry model. Okay. In subsequent illustration, I will guide you how to prepare the cash book directly, that you may already know. Okay, anyhow, go and see the solution given in Singar Academy book for your better understanding. In subsequent lecture, I will focus on that, because in this illustration, my focus is to make you understand the forfeiture logic. Yes, come on, pass journal entry here. Up to forfeiture, the entry is normal. The illustration seems to be normal only. Yes, an application, bank account debit to share application, 3 rupees per share for 15,000 shares, 45,000 you receive. The next one being, how do I handle the application money? Share application account debit to share capital. How much is transferable to the share capital? To the extent of actual number of shares proposed to be issued, 10,000. 10,000 into 3, 30,000 rupees. Out of 45,000, 30,000 is for share capital. And this 2,000 share application money is going to be rejected and amount is refundable. So share application to bank, 2,000 into 3, 6,000. And remaining 3,000 for 13,000, 10,000 were allotted, right? The excess application money for the shares allotted in pro rata, rather than refunding, can be adjusted in the next due, named as what? To share allotment. This value being 3,000 into 3, 9,000. Then on allotment. On allotment, the entry being due entry. Share allotment, the amount recoverable for allotment being 5 rupees per share. For 10,000 shares, 50,000 we have to receive. Though we have to receive 50,000 rupees, 3 rupees is for the capital. Okay, 3 rupees is for the capital. Share allotment to capital. 3 rupees into 10, 30,000 rupees. Another value will be securities premium, 20,000 rupees. Is that clear? While receiving, already we have the excess application money to be adjusted, which is 9,000 rupees. Now I just adjust this 9,000. Here the bank account debit to share allotment. 50 minus 9, 41,000. 41,000. We got that. Now, we'll move on to the next one for first call and second call. On first call, the entry being share first call account debit to share capital. 2 rupees per share for 10,000 shares, 20,000 comfortably. So bank account debit to share first call, the value being 20,000. And in case of share second call, due entry being 2 rupees per share for 10,000 share, share second call account debit to share capital 20,000 rupees. Come on, tell me. On collection, bank account debit to share second call. How much is collected? Come on, text me. How much is collected? Here only there is a default. There is a default. Tell me what is the amount collected? Now, see, out of 15,000 shares applied for, 2,000 rejected. Balance 13,000 share applicants getting how many shares? 10,000 shares. Am I right? This is issue. This is allotted. For 15,000, 2,000 applicants gets nothing. 13,000 applicants gets 10,000. This defaulter applied for how many shares? 260 shares. Then how many shares he might have been allotted? Do the cross multiplication. 10,000 into 260 divided by 13,000. 200 shares allotted. Though he applied for 260 shares, he got allotted only 200 shares. If he failed to pay the second call money, means he failed to pay only for the number of shares allotted for 200. For 200. So per share, it cost us 2 rupees for 200 shares, 400 rupees has not received. So out of 20,000, 19,600 is received. Be careful. That's why I give the space to explain. Clear? Clear? It is not ended 260. 260 is the applications. For the pro rata cases, if you are applied for 13,000 shares, you are getting only 10,000. Means this fellow applied 260 means they might have been allotted only 200 shares. For the 200 shares, call money 2 rupees not paid. So 200 into 2, 400 rupees is missing. Now, we'll go for what? Forfeiture. We'll go for forfeiture. So, on forfeiture, 3 journal entries are there. Okay, on forfeiture 1 entry, on reissue 2 entries. On forfeiture, what is journal entry for forfeiture? Here only share capital is going to be debited. Amount collected is transferred to where? Share forfeiture account. Amount not collected will be cancelled in their name. Share second call 20,000 in the debit side, 19,600 in credit side, 400 rupees remains uncollected. To cancel that, I name here being share second call. This is a general share forfeiture account. Come on, tell me. What value we have to record for share capital account here? What value? Called up value. Don't say face value. Okay, don't say face value. It's only called up value. What value is to be posted in share forfeiture? Paid up value minus securities premium collected, if any. This share second call being the default. And even sometimes the securities premium will also come in the debit side if the securities premium not collected. Here the securities premium due being the allotment due collected promptly, there is no any default in securities premium, you don't need to reverse this. Now, What is the value here? 10 rupees, fully called up. Number of shares forfeited here being 200, so 200 into 10, 2000 rupees. And paid up value being only 2 rupees not paid, 8 rupees paid up. So 8 into 200, 1200, 1600. What is the amount defaulted? 400 rupees. Hope you will be now able to understand this one. This entry is very important for forfeiture entry. After forfeiture, go for reissue. In case of reissue, we have two entries. What are they? One is reissue entry, bank account debit to share capital. Come on, check whether there is any loss or gain on reissue. How will you record? Bank account is the amount collected. Share capital will be recorded at what value? Paid up value. The paid up value being 9 rupees for 200 shares. 900 into 200. 9 into 200, 1800. Sorry. What is the paid up value? Nothing stated. It means fully paid up. Fully paid up. Amount collected being 9 rupees. Amount collected being 9 rupees means 9 into 200, 1800. And amount recorded as paid up in this case is fully paid up. Nothing stated means fully paid up. 2000. The difference between these two is the loss. Loss will be adjusted in which account? Share forfeiture account. So twin brother like we have one more journal entry. Any loss in share forfeiture after adjusting in the share forfeiture gain, balance is transferable to the capital reserve. So further the entry being share forfeiture account debit to capital reserve. 1600 between these two, 1400, no more required, is transferred to CR account. The CR account can be posted this way also. How? Forfeiture gain, reissue loss. Balance amount will be transferable to CR account. What is the gain on forfeiture? 8 rupees. The amount collected per share will be the forfeiture gain, 8 rupees. What is the reissue loss? Reissue loss is nothing but the difference between the amount collected and amount credited for 1 rupee. So you reissue at a loss of rupees 1. 7 rupees is the capital reserve amount for every share. How many shares reissued? 200 shares. The ultimate value being 1,400. If you are master with the last 3 set of journal entry, you don't have any confusions with respect to issue of shares at all. Is that clear? So rest of all the illustrations are very easy. Cakewalk like you can finish up, but you have to put your more attentions for the forfeiture, reissue as well as CR transfer. So currently what we have done? So we have done this one. Fully called up state forfeiture. Forfeiture reissue at loss. Fully paid up reissue happened. So I have not included partly called up forfeiture, partly paid up reissue. And in case of gain or par on reissue not completed. So we have completed all the items. So now you have to complete the rest of the 3 so that will be mastered with the second block also. Okay. Yes, come on, make note of it. If you have any doubt, you can ask me. Now, in case question number 9, continue with the previous problem. All the dues were collected except the shareholder who applied for 260 shares failed to pay first and second call. His shares were forfeited and 50 shares of which were reissued for ₹11. So you have to incorporate this one only. Past journal entry from first call onwards. For past journal entry from first call onwards. You don't need to repeat completely. Is that okay? So fail to pay, first and second call, and reissue price being 50, but all the forfeited share not reissued. So 200 forfeited shares being 200, reissue being only 50 share at rupees 11, at rupees 11. So reissue at the premium. Yes, come on. On first call, what is journal entry? Share first call account debit to share capital. 10,000 into 2, 20,000 rupees. While collecting bank account debit to share first call, how much you collect? You collect other than 200. 200 into 2, 400 rupees not collected. So you collect only 19,400. Though this fellow applied for 260 but allotted only 200. For the 200 shares only we didn't get the call money. Let's go for the second call. Share second call account debit to share capital. 20,000 rupees. What about the collection? Here also default is there. So balance default. After default, we collect only 19,600. Bank account debit to share second call. The value being 20,000. Clear? Sorry, 19,400. 19,400. 19,600, right? Sorry, 19,600. Here also 19,600. 200 into 2, 400 not collect. Now on forfeiture. Past journal entry. What is journal entry? Come on. Share capital account is debited on forfeiture. Any amount withheld will be named as share forfeiture. Default will be credited in its own name. What are the defaults are there? Share first call to share second call. These are the two default we have. And at what value I am going to debit the share capital? Called up value. What value will be shown in forfeiture? Paid up amount we collected minus securities premium if anything collected. And these two are the default. These two are default. Fully called up shares. So fully called up means 10 rupees. 10 rupees into 200 shares. 2,000. Amount collected being 3 plus 3. Except what? Securities premium collected will not be taken. So 3 plus 3, 6 into 200, 1,200. For first call, 2 into 200, 400. For second call also 2 into 200, 400 rupees. Okay. On forfeiture. The next entry being on reissue. On reissue. Is that okay? On reissue, how can you pass a journal entry for reissue? Amount collected will be posted in the bank account. Amount credited to the share capital account will be posted in the share capital account. What about the value here? Amount collected. This one being paid up value. amount collected being 11, but the number of shares reissued being only 50. So 50 into 11 collected 550, but the share is considered as partly fully paid up. Fully paid up to 10 rupees. 10 into 50, 500 rupees. So 500 rupees, but you collected 550. 50 rupees excess amount you collected will be always named as securities premium. If you collect lesser, then this is the loss transferable to the share forfeiture. If you collect more, gain will be always named as share securities premium. But it's twin ratios, it's a twin journal entries. The another journal entry being share forfeiture account debit to capital reserve. Come on, get the value here. Get the value here. Share forfeiture gain account debit to capital reserve. Are you able to understand? Not giving me the answer. Come on, make it faster. Make it faster. Already told you, no. Forfeiture gain per share. What's a forfeiture gain per share? 6 rupees. Application allotment, these two put together 6 rupees. What about the reissue loss? Reissue loss is 0. We issued at premium only. We don't have any loss. Then difference between these two is the forfeiture gain left over after the reissue can be transferable to the capital reserve. Multiplied by number of shares. How many shares are going to be reissued? 50. 50 into 6, 300 is the answer. Otherwise, you can work out this way also. 1200 rupees is the forfeiture gain for 200 shares. Now, how many shares out of that reissued? Only 50. So, divided by 200 into 50. This will be the amount available. From there, reissue loss, if any, can be subtracted. This is the amount transferable to the capital reserve. So, any unissued share is there? No. For 150 share, for unissued 150 share, you have no. Further, the capital reserve being 3 plus 3, 6. 900 remains unutilized. It can be placed on reissue of the remaining 150 shares in the later period. Whenever there is a forfeiture gain, you can use a forfeiture gain for the reissue. If you are using only partial reissue, only to that part of share forfeiture can be used. Remaining forfeited shares and the gain on that will be kept as it is in forfeiture gain until it is going to be reissuable later on. Clear? Out of 1200 for 150 share it is 900, for 50 share it is 600. This 600 only used now. In that 60 reissue loss 0 is subtracted, so balance 600. Okay, what's the value? This is 900, this is 300. Okay, this 300 minus 0 is transferable here. Clear? That's very, very important. Clear? What happened to you? Are you able to understand?